Hey everybody, happy Wednesday. No, it's not Wednesday. Happy Thursday. Welcome to the webinar. We're going to talk about how I am of the conviction that options are a better way to invest in stocks. And so over the next 45 minutes or so, we're going to walk through how to look at that and as the objective of where we'll be ultimately, you would walk away with this with the knowledge of how to answer that question and at least be able to talk about that in a more intelligent way. Before we get going, a couple bit of housekeeping. First, we are always mindful of risk when included in any investing. You always hear the, do your own research. I would actually put this in the part of doing your own research, trying to arm you with really actionable information to be the investor that you want to be. If we've not met, I am Josh. I'm the founder of MeFlow and been in the markets for about 15 years, both stock side, future side, and one of the co-founders of MeFlow, which is an app or platform designed to give this next generation of investors a new investing playbook so that they can see the outcomes that they're looking for with respect to their investing. So with that, let's dive right in. Okay, a couple takeaway wins that I hope for you at the end of this session. One is that you understand what options are. Some of you may be on this call and you don't really know what an option is. You hear stocks and options. After this session, you should be able to know what that is and how to articulate that. I'm going to try to make that as simple and accessible as possible. Understand how options are better than stocks for investing. There is there is classically kind of this perspective that options are a bad idea, and we'll talk about where some of those perspectives come from and where there's validity to that, but how to think about options in a way that will give you a much better and I think cleaner approach to what you're trying to do. And then finally, we'll know where to go to start folding options into your playbook. Okay. So we're gonna get one little thing here going here. Make this just a little bit easier. And we can rock and roll. Okay. Something I would have you kind of hold in your head as we go forward is, how can we do better than 6.7% compounded over 20 years? Where does this come from? What's the 6.7%? So the 20-year inflation-adjusted return of the S&P 500 is 6.7%. If you have a retirement account, 401k, an IRA, 403b, whatever type of retirement account that if it's in some way exposed to the broad indexes, the expectation is that it's going to try to beat the benchmark, which is 6.7%. That's the S&P 500. Now, Warren Buffett would always talk about the magic of compound interest. And in fact, even at 6.7%, which that doesn't seem that big or that impressive, but compounded over 20 years can be significant. So what we're talking about is, well, what if you wanted to do better than that? What if, let's say, you could do 10% a year over 20 years compounded? Or what if you could do 20% over 20 years compounded? Could that significantly impact the outcomes that you experience within your investing plan and within your investing goals? And one of the reasons that investors go to look at options is really to give them options, because if this is based on the S&P 500, which is the benchmark, what else could I do? So one of the things that people do in an attempt to get better than 6.7% is they try to buy stocks and they try to pick stocks, and this is fairly well understood. The idea is you buy low and sell high, right? Yay, simple. Like that's, but not quite so simple. While the long-term trend of stocks is higher, that benchmark 6% is not been beat over 20 years. So there's not been a demonstrated fund manager who's been able to pick stocks and beat the S&P 500 over 20 years. Um, for one reason, while stocks most of the time go up, it doesn't give you anything to do when stocks don't go higher. So if they're not going higher, if they're just going sideways, or even worse, they're going lower, it really offers no option for you. And so the best way to approach this, I think, is if you think stock picking is the way to go. I mean, you could try that, but then I would say, Jack Bogle was right. Um, Jack was the founder of the exchange traded fund, Vanguard. He is the inventor of a product called the SPY. It tracks the S&P 500. I mean, literally, you can buy that as shares and buy the benchmark. So if that's like if that's what we're going for, just buy the benchmark. Just buy the SPY. Like you don't have to worry about picking stocks. You will effectively always buy the best stocks. And that's the results you get. Easy, compound that over 20 years, you'll be in good shape. But again, what if you want to do better than 6.7%? What is the way to do that? Well, if stock picking doesn't do that, what about options? Like what can we do with options? Well, let's talk about options and what they are. I'll give you a base understanding. This is at least going to make you interesting at um, at parties. It'll make you uh, more enlightened. Um, this is a P&L graph for a stock, which we all understand. If the price is if here's the current price and the stock price goes like this, the P&L goes up like that. Okay, fairly easy to understand. Now, what does an option do, and what is an option specifically? So an option is a contract. And it's based on that underlying stock, and it gives an investor. So if I get an option. I open an option. It gives me a right. So I'm not obligated to do anything, but it gives me a right to take some action on a stock at a certain price at a certain time in the future. Okay. So another way to think about it is like it's a coupon that has an expiration date, and that's going to give whoever holds that coupon privileges on that stock. Okay. So all right, let's say more. Well, one, there's two types of options. So there's calls and puts, and those are like call and put. Like, what in the world does this mean? Well, let's talk about that. Each contract, for example, controls 100 shares. So when you think about an option contract, you're talking about controlling 100 shares of the stock. Now, if I buy a call option, I am establishing the right to call away 100 shares of a stock at a certain price in the future. That's where the word call comes from. Now, if I put, I'm buying the right to put stock to someone at a certain price in the future. Okay, so buy a call, buy a put. Now, they can be bought to open, but they can also be sold to open. So this is interesting. This is going to be a different understanding for someone who's just brand new to the idea of options. Is that when we think of stocks, we think, well, we can buy a stock, and that's how I enter this position. Now maybe you've heard the terms of shorting a stock or selling stock. When that happens, you have to essentially borrow stock from someone, and then that becomes a balance sheet transfer. Options are different. Options, when they're opened, you can be the person who buys it. You can also be the person who writes it. Think of it like writing an insurance policy, because effectively, why do options exist? They exist and they were designed as a product that investors could use around their existing portfolio for insurance. So if I want to be protected against prices going higher, I can buy a call. And we'll talk about why that would, make a difference. Or if I want to be protected against falling prices, I can buy a put. We'll talk about, the mechanics of how that's priced. But there are these instruments that can be bought to open or sold to open. The buying or selling piece, it's opening or closing is how we establish those or close those positions. Okay. So that can be a little bit confusing. An interesting thing also about options is that while there's a limited supply, or called the float, of a stock on the market at any given time. In fact, companies, when they go to issue shares of a stock, which is a financing vehicle for that company, it has a limited supply. There's a finite number of shares that are released. There is no limit on how many options can be written. So even though an option offers the ability for someone to take an action on 100 shares of stock, you can actually have more options written than there is stock. And we today live in a world where like the in-play names that you would know, like the Nvidias and the AMDs and whatever hot stock is out there, you will look at that stock, and if you look underneath the surface, what you'll find is that there's far more volume in the options than there is actually in the stocks. Because this is where the world is. It's option is a derivative of that underlying vehicle, but because of how they're priced, they end up kind of driving where everything goes. Okay. Um, but why do investors also go to them? Again, it expands your playbook to be able to, if you're just buying options, you can now, okay, now it's not just appreciate if prices go higher, but I can also appreciate if we get lower prices. So that's an expansion. So let's walk through an example of like how an option is priced through expiration to kind of get a better understanding of how that works. Okay, so let's say Nvidia is trading at 173. And then I buy a 180 call that expires on August 15th. So I'm buying the right to call Nvidia away from someone. I can get 100 shares. So for every contract I buy, I can get 100 shares of Nvidia, and I can get that at $180 a share on August 15th. Okay. And today, it's, a month earlier, it's 173. Okay. So if I go and buy this contract, today it's trading at $4.15. So it's actually trading at a premium. So that's $4.15 per share, um, is is the value of this option. So basically it's like $184.15 is what this option contract is valued. Now you like hold the phone, because if Nvidia is at $189.99 on August 15th, it's this contract doesn't have any value at all. Why is that? So again, I'm buying the right to buy Nvidia at $180 a share, but it's trading at $173 right now. But I don't know if it's going to be trading at $190 a share. So if on August 15th, let's say that Nvidia is trading at $190 a share. Okay. Would it be attractive to be able to buy it on the 15th at $180 a share? Like if I had the right to buy it at 180, that would be great, especially if I could buy it at 180 and nobody else could. But I don't know yet. So this value here is based on the probability of whether or not Nvidia could be at that price by expiration. Now, on August 15th, if we're trading at 189, why would anyone buy a I'm sorry, if they're trading at 189, um, this is actually incorrect. I meant to say if they were trading at 179, not 199. If we're trading at 179 at expiration, why would anybody buy the contract? You could just buy the shares. Okay, so that contract doesn't have any value. And this is what impacts the value of these contracts. So the contracts change based on the probability that will be at a certain price at some point in the future. Now, if Nvidia is at 190 on August 15th, right? It's worth $10. Why? Because 180 and 190, that contract is worth the $10 spread between those two. So, if I bought it at 415, I could sell that option like right before expiration at $10 because it's right close to 190. Because at expiration, it's going to be, what it is minus where we're currently trading. So that would mean that would, now be $10 minus 415 if I bought it. Dude, um, which, I'm what, 585? So $585, because it's this times 100, $585 would be my profit on that option contract. And so there are people that will try to go to these contracts instead of the underlying shares. Now, why is that? Because they're cheaper. It gives you leverage. They also can establish a floor. So if I buy a stock, it looks like this. If I buy an option, okay, if I get above that certain strike price, it has a lot of value at expiration. But there's a floor. There's a max on what I can lose, and we're going to walk through an example to look at what that max that you can lose. Whereas, like if I have the stock, I can lose for every penny that it goes lower, right? Um, and this is what introduces the problem of price and time. So when people have had bad experiences with options, they realize that, oh, so because this contract, its value is based on kind of a probability of being a certain price and time. If on a stock, to win with a stock, I just have to have the price right, right? I have to buy it lower than where I want to sell it. But on an option, there's a fixed window upon which I need to be able to have this thing at a higher price. It's hard enough to pick a direction on a stock. And now I'm going to add an additional layer of complexity by trying to, buy that stock's price within a certain time. The probabilities of success are very, 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 very low. So, if you're going to buy calls, just get ready to the idea that you're going to lose a lot of money. Because again, when you buy a stock, you have to be right on price. When you buy an option, you not only have to be right on price, but you have to be right on time. And the reality is then 95% of all options written expire worthless. And why do they expire worthless? And because this pricing of the options, and this is a really, really, I mean, this will make you really popular at a cocktail party. Every option transaction is transparent. So some stock trades can be hidden from the market for a period of time. Let's say that I'm a CEO of a company and I really believe in the company. I want to buy additional shares in the company and I don't want to unduly impact the price of the stock because that could be news. And if you're a director in a publicly traded company, you have to file and disclose that you make these transactions, but not necessarily on that day. And so I could go to Goldman Sachs and I could say, hey, I want to buy X number of shares. They have shares kind of off book that they can transact. And because in stocks, there's not a singular exchange, those transactions can be hidden. But options operate on what's called a national best bid and offer, meaning that all option transactions are transparent. And when I see all of these transactions and I can see where people are participating at certain strike prices, that tells us the probability that we'll be at certain prices because we have basically participants who are buying and establishing positions based on prices they believe the underlying product will go to. And that's actually what drives stock prices is what's happening. There's a feedback loop between people buying and selling options and market makers who are auto hedging these positions that establishes the range that stocks can be in. And that's all transparent. Well, imagine that you could go to Vegas and play poker and you could see everybody's hands. People would play very differently if you could see everyone's hands. The probabilities would get a lot tighter of like whether you win that hand or you win that hand based on what do I have in my hand and what's the probability of that suit that hand being played in a hand of cards. So options are the same way. That's so it becomes very predictive of whether I can get to this price or not. And because of that, there's typically a chain of when people go to options and they try to buy options and they find out they just don't work because they're priced very efficiently because everything is transparent. So then they go, well, why buy it when I could sell it? So if I can open a position by selling an option and they expire worthless, well, I'll be the seller and I'll just collect all the stuff that expires worthless and I'll get the delta between what it's sold. So, how you can sell an option is like, let's say if I had that Nvidia option and I was the seller instead of the buyer and I sold it at $415 total, like that's a credit that I could receive in the position. Well, at expiration, if it's zero, I walk away with $415 of premium that I've collected. All right. And that's actually fairly probable. However, um, When I sell an option, yes, if they expire worthless, I should sell them. But this is where we get what's called unlimited risk. And this is if you've heard people say, "Well, hey, oh, don't ever do options because you can lose more than you invest." It's in this case when you're doing an unlimited risk position. So when you sell an option, there's a floor on what it can gain, but there is no ceiling on what it can lose. It can go infinitely against you. Um, so this is a challenge. So when up to this point where people say, okay, yeah, options are never better than stocks because they expire. I have to be right on price and time. They could be unlimited risk. Most of them, don't work. I totally understand the arguments for why someone would say, hey, stay away from options. And yet, here's a key insight. Um, Buying an option or selling an option is what we would call a naked position, meaning you're doing that uh, just by itself. That is where all the risk in options is naked options. Buying naked calls, selling naked options, or buying naked calls and puts, selling naked calls and puts is a great way to lose money. So if you want to see less than even the 6.7% compounded annually over 20 years, do that. But there's another way, and that way is to use spreads. And what a spread is, so here's a an option order. This is actually four contracts all together at once that create one position. Right? This is what we would call a multi-leg option strategy. And this, if you're going to be in options, is the way to go. Right? One, you're reducing the risk of selling options. Why? Because while I may be selling, like let's say that I sell a call, I'm also at the same time buying a call. And while this has an unlimited risk, this has a limited risk, and they cancel each other out, giving me a defined risk position, meaning that unlimited risk piece goes away, which is wonderful. They retain the leverage of buying options. So why do people like to buy options is because they can control 100 shares for far less capital than just buying the shares. So I can still do that. I can still also incorporate the probabilities that was attractive about selling options. And I can also leverage what we would call positional analysis, meaning I can look at where other participants have positions, kind of like playing poker where I can see all the cards and use that to my benefit. And then this further expands the investing playbook to give me ways to grow balances if an underlying stock or index is going up, down, or sideways. So, if we go back to the idea of like how do I beat better than 6.7%? Well, let's think about what the S&P 500 has done this year. We're what, maybe 4.5, 5% up for the year. But what has happened this year? Like we have gone down 20%, we went up 25%. To get a net above the last year of 4.5%. That's a lot to weather. Okay. But what if I had the ability to appreciate on the way down and appreciate on the way up? We ran a model within our system and we did a 25, well, we did several different accounts sizes, but 2,500, 10K, 50K, 100K, using multi-leg options. And between January and now, it's done 35%. And that's while there was still 25% unallocated at any given time, not more than 25% of allocation within a specific idea. So it because you can express things down and up and sideways, you can have a much bigger long-term growth that you think about that compounded over 20 years, what that could do for you. Okay. So let's look at like some just significant example, or not so significant examples, but like let's just look at some raw examples of comparing like a single option, a stock, and a multi-leg option to just kind of hammer this home. All right. So here's three different ways to invest on the same asset. Let's say that I believe that a stock is going up. It could be an index as well. Um, these are the P&L curves of each of these different approaches. So one is buying a stock, one is if I just buy an option, and the other, you'll notice the really weird one on the right, is if I'm buying four contracts in what's called a call butterfly. So on the stock, it's easy. I just got to go higher. On the option, if I've got to be above a certain price to go higher. On the call butterfly, still built around the idea that stock's going higher, but I actually just have to be within a range of prices at expiration to make money. So I don't even have to be at a certain price. I can just be within a range of prices and be profitable. And so notice this white line is the P&L. What we're going to find is that I'm going to spend a lot less to have the potential to make a lot more relative to any other instrument. So if I'm going to buy, for example, 100 shares of the SPY. Okay, so if I want to buy 100 shares at $530 a share, it's going to be $53,000 in capital. All right. And if I get to $560, then I could make $3,500. That's a 6% return on capital. Now, if I buy the call, just buy one option, and let's say I got the time and price right, which we know that's challenging, I could make $1,850, which would be a 90% return on capital. But if I bought the butterfly, I'm now going to see potentially $2,000, which is a 240% return on capital. So if I was trying to be a better manager of capital and risk, when at the end of the day, I mean, here's the ultimate P&L impact if I don't do anything. I'm going to lose the least doing the multi-leg option and have the greatest possibility of the highest return on capital. Like multi-leg options is the way that you want to go if you want to use options and if you want to see more than 6% inflation adjusted over time. Now, why have we not seen lots of multi-leg options up till now? For a couple of reasons. One is they're complex. It's hard to find them. It's hard to execute them. So, I mean, buying a stock, you put in a quantity and a price, and you go. You buy an multi-leg option, and you're now entering four contracts at once, and you've got to pick the right expiration on top of that. That's really complex. Not only that, there are multiple different types of multi-leg option strategies based on whatever's happening in the underlying stock. So it's challenging to find the right stock for the right strategy. And last but not least, they have been historically expensive. So, I mean, I look back in my career and I know there were times when for each contract that I tried to enter, it was $10 in commission per contract. But some significant things have happened recently that have kind of shifted just the whole space in our favor. First is these two guys. These two guys, Vlad and Baiju. So these are the founders of Robinhood. If you don't have a Robinhood account, you likely know who Robinhood is, but they brought some significant technologies to the space that really disrupted the financial industry in some really positive ways for self-directed retail investors. The biggest one is the reduction or the elimination of commissions. So in the past, like I said, I could buy, if I wanted to do a multi-leg option contract, it might be $10 per contract. Well, today I could do that for $0. Historically, I could get those kinds of prices, but I would have to have a leased seat on the exchange. So I could go to the New York Stock Exchange or the Chicago Board of Options Exchange, and I would literally buy a seat to be able to like interface directly with the exchange and get that pricing. That is now available to everyone. So a significant barrier to like like what's possible within these strategies is in your favor just because the costs have gone away. So, for example, if let's imagine that I put on a position in the past, and it cost me $50 in commissions. Well, even if it's a break-even trade, if it's $50 to get in and $50 to get out, I'm net down 100, even if it's a break-even trade. Now I'm just at 0. Like that's a remarkable strategic advantage that's now available to any self-directed retail investor that didn't exist before. Now that's the pricing piece. What about, finding these ideas, right? Well, I mean, there are lots of resources that are out there that can help you find multi-leg option ideas. What we do, what MeFlow does, is simplifies all of that for you. So if you understand what the benefit is of a multi-leg option and how that can be as an investment, what we're going to do is we go and tee up and find what is the best candidate stock for a specific strategy and deliver that in a digestible way. So we're going to go over here real quick, and I'm just going to walk through a couple examples of how MeFlow works and how you can see these, and uh, just further get some understanding on how that works. So I'm going to go in here to, let's call my flow. So these are multi-leg option strategies that are ideas for today. Okay, so they're all multi-leg option strategies, quite a few of them actually, and they're all based on underlying stocks or ETFs. So, for example, here's BitX, so if you're or IBIT, so if you're following Bitcoin or crypto, those are great ones to be. BITO as well. EEM, that's emerging markets ETF. ARK, if you're a Kathy Wood favorite. Um, how are we coming up with these stocks? Because we're looking at what is happening in the underlying options to tell us what are the stocks that are in play. Part of picking better stocks is knowing which stocks are in play. And we're identifying that and then finding out which of those stocks is the best candidate for one of these strategies. So today we have call butterflies and put butterflies. Um, I can look at each one of those and say, okay, based on the capital that I want to deploy, what's the max potential profit? Notice that for all of these, the capital required and the profit offered is asymmetric reward to risk. Why is that so important? Is that whenever in an investment, because I'm not going to be right all the time, I want to have that when I am right, I want that to pay more than the times that I'm wrong. But it's not just this. Let's look at this ARC position, for example. Okay, so here it is as an idea. It's got 3 option contracts. And a buy call butterfly, for example, is buying 1 call, selling 2 more calls, and buying a further call, all in the same expiration. Historically challenging to execute. I mean, I had an experience where I lost a significant amount of money of buying an option on the wrong expiration and they expired, worthless. Um, we're removing that risk. So if I want to send this to a broker, I can simply select the route. I can put in the quantity and it will pre-fill what we think is the most advantageous price, and I can execute the trade. And this is going to immediately route that order to the broker. It's going to price all 4 of those legs, and then, when I get a fill, the position's open and I can track that. Now you'll notice down here, it's not just having ideas, but it's about having risk management. So, whether you do anything with us, a great takeaway in your investing is to always think about, how do I know that I'm wrong? And so we'll give you alerts every day to tell you, as long as this stock stays between 72.11 and 90.65, we like it. If we close outside of 72.11 and 90.65, then you'll get an alert. And we send alerts here on the platform and also via email, either of like, hey, there's a new idea, or hey, I have an idea that I need to address because it's past one of those prices, which can actually even help you not take that full loss, but just get out at either a break even, because we don't have to pay commissions to get out, or at a very small loss. What's the ending result is that you can have a P&L curve that looks like this, where it's, stair stepping up and to the right. Here are current ideas that I have open. Like, these are all multi-leg options. And I can go and identify any one of these and say, okay, well, how are they currently doing? How long do I have until it's expired? And if I want to close it, I can just set it and forget it. Here's the target price, target profit. And now there's a closing order that's just sitting out on the brokerage. And, I can check the status here all the time. If I want to go look at it on the brokerage, I can, but I can keep it right here, and this keeps me abreast. Like if multi-leg options is a way to be able to do better than a 6.7% inflation adjusted over 20 years. What we're trying to do is make finding those and executing on those and managing those as simple as possible. Because the reality is, man, like not a lot of us have time to do this. I mean, I know there's some that are on this call that are really active investors, and you already understand quite a bit of this, but there are so many people who don't want to look at a chart. They really don't want to understand a lot of the mechanics, but if they could understand how multi-leg options as an approach to investing is better than naked options or even trying to pick stocks. I mean that would be kind of my takeaway for you in all of this. It'd be, if you don't want to do multi-leg options, that's fine. Buy an SPY ETF and call it good. Like that's as simple as it's going to go. Don't waste time, trying to pick stocks. You're going to spend too much in capital when it's not probable. Don't spend time doing naked options because you'll spend less. If you're just buying options, it'll be, death by a thousand cuts. If you're trying to sell options, it'll be great. And then you have one thing that just absolutely runs you over. And I'd rather that neither one of those was the case. But multi-leg options is a great way. It's a great way to approach. So like the other day, I had a friend of mine who said, hey, I just got out of this investment. What stock would you recommend? And I don't hold stocks. I hold the SPY as like a long-term holding, but growing my account is done with multi-leg options. So if you're willing as an investor to be a little bit more active, and when I say a little bit more active, I'm talking about the millions of Americans who have retirement accounts. They look at a statement once every quarter. Maybe they looked at it a little bit more frequently this last spring. But if you're willing to look at something, like every day, if you get an alert and then just do nothing, if there's nothing to do, I think you could do a lot better than 6.7%. So just kind of, sum up here. Options are very risky if you're buying or selling naked options. They are very capital efficient and probable to invest with if you're deploying with multi-leg options. So whether it's with MeFlow or someplace else, if you're looking for a different way to approach investing, I encourage you to look at multi-leg options. There are lots of resources out there. The Option Industry Council, the Option Clearing Corporation, which are the parts of the regulatory bodies, the Chicago Board Option Exchange. I would encourage you to look there to get just some really good foundational understanding from the professionals and institutions within the space, and then you could go from there. But if you are, willing and decided, hey, I want more than 6.7%, I'd say start with a free trial of MeFlow. It's not required if you've never done self-directed investing for yourself. One of the hurdles or one of the things that you have to have is you have to have your own investing account. So if you're like, well, I don't know, I want to go through all that, that's fine. If you start with a free trial of MeFlow, and we allow you to have a practice account that you can just practice these ideas, and you can set it, whatever balance you think you'll be. You can practice it in a paper environment, and then whenever you're ready, go get that brokerage account and tie it to MeFlow and let MeFlow drive the management of those executions that you select and give you information on how they're doing. That's it. That's all I've got. Thanks, everybody. I think we've got a little bit of time left that we can just open the floor if anyone has some questions with all of this. Otherwise, we will be done for today. So I do have the chat open and the Q&A box. You can use that. And I'm actually going to go look and see if there are any other ideas that I'm interested in for today. So here is this practice account. So if I don't want to actually send it to a broker, I can just put it in a practice account. Now, practice account is a little bit like it's going to immediately open the position. And this will update every day. When you tie it to a broker, uh, there's a pending order that has to be filled, but it's a way that you can experience what that will be like. And then you can go to the account overview and get an idea of, how are my positions doing, whether that's, in a brokerage sandbox or live account, or it's in the paper account. You can also select which of these that you want to see if they're ideas. So I have these are all of the different types of multi-leg option strategies that we use. It's not required that you have that. So you can actually customize the flow of ideas that come to you based on which ones you select or not. But it's a good way to go. It's a great question. Are you required to have a large amount of cash or margin if you put on multiple leg options, or does the sell side cover the capital needed for the buy side? In every one of these ideas, so you'll notice where it says capital required is $99, that's what's required. Like that's the capital that's required for one spread. Now you can always do multiples, right? So if I did two, it'd be $200. But what's demonstrated here is the capital required for one quantity of that spread, and that's the potential profit on the one quantity of that spread if it hit that max profit. But yes, part of what makes them more capital efficient is that you have these options offsetting each other. So the credit of the one offsets the debit of the other, and it makes it much more capital efficient. This is why multi-leg options have been the vehicle that institutional professionals have used for decades. And they used it because they could do it directly with the exchange and not have the fees involved. This is now available to everyone. The ability to get into these at a better price, they still have a leg up on you in terms of the understanding of, which stock is a good candidate for which strategy. That's the other barrier that we're trying to remove for you. One of the things that I also like is that um, a classic challenge for a self-directed investor is that they don't have another idea. They will ride an idea into the ground. I had a friend the other day who's like, "Hey, I bought this stock is at this price." I was like, "Well, that's great," and he'd been holding it for 6 years, and it just finally got back to break even. And I was like, "Okay, I mean, great that it's back to break even, but the opportunity cost of that was massive. I mean, it'd been better to like cut the loss on that and put it into something else. But if you don't have another idea, what do you do?" On MeFlow, if you get an alert that something needs to be addressed, and I think I actually have one of those. Let's go look at my, yeah. So like this one, you can see this is flagged for risk. So I have an NVIDIA position. So it was we're at 173.84. We're above this upper abandon price. So that means that I should get out of this, and I'm flagged for risk, so I can close the position. Let's see where the current price is. So 1051. All right, so I've got that close order. I'll check that here in a little bit to be able to get out. But what's a challenge for people taking losses around these is because they're like, well, what would I replace it with? Well, it's great. I'll free up the capital that was deployed to this, and I'll put it into another idea. Like that's what I'll do, um, and it'll be just fine. Yep. All right, gang. Thanks for hanging out with me. I hope this has been helpful. And We'll make the recording available. You can go back and take a look. If you have any questions further, feel free to shoot those to us at team@meflow.com. And if you've not done so yet, I encourage you to sign up for a free trial of MeFlow and see how easy it can be to find multi-leg option ideas and add them to your investing approach.